Welcome everyone to House Lux Estate, your reliable guide to financial literacy and wealth building. We're here to provide you with valuable insights and strategies to help you navigate the world of finance. We aim to make complex concepts simple and understandable. With your subscription to our channel, you'll gain access to a wealth of knowledge that can help you build and maintain wealth. Today, we're going to explore an intriguing strategy known as dollar cost averaging. Stay tuned as we delve into the concept of dollar cost averaging and how it can help build your wealth. So what exactly is dollar cost averaging? Let's unravel this term. Imagine you're crossing a mountain range. Some days the path is smooth and easy, others it's steep and challenging. Investing can feel a lot like this. Dollar cost averaging is like your trusty walking stick, providing stability and consistency on your financial journey. At its core, dollar cost averaging is a strategy where you invest a fixed amount in a particular investment at regular intervals. It could be weekly, monthly, quarterly, or whatever works best for your budget and investment goals. The key is consistency. Imagine buying shares in your favorite company. Instead of investing a large sum all at once, you decide to invest a fixed amount every month. Here's the clever part. When the price of the shares is high, your fixed investment buys fewer shares. But when the price is low, that same amount buys more shares. Over time, this strategy averages out the cost of your shares. Hence, the name dollar cost averaging. Now, why would you want to do this? The primary reason is that it reduces the impact of volatility on the overall purchase. The financial markets can be unpredictable, sometimes swinging up or down without warning. If you invest a large sum all at once, you could be buying at the peak, which means you'd lose money if the market drops soon after. With dollar cost averaging, you're spreading out your investment over time. This means you're less likely to be caught out by short-term market fluctuations. Instead of trying to time the market, which is notoriously difficult, you're committing to a long-term, consistent investment strategy. You're playing the long game. In essence, dollar cost averaging is a strategy that allows you to invest money systematically and reduces your risk in volatile markets. It's a financial walking stick, helping you navigate the ups and downs of your investment journey. So, are you ready to take the first step? And now that we know what dollar cost averaging is, let's explore how it works. Imagine a simple seesaw with the price of a particular investment on one end and the number of shares you can purchase on the other. When the price is high, the number of shares you can buy is low. Conversely, when the price is low, you can scoop up more shares. This is the basic principle of dollar cost averaging. Let's dig a little deeper. Suppose you commit to investing a fixed amount of money into a specific investment at regular intervals, say every month. This could be a stock, a mutual fund, or even an index fund. Now, the price of this investment will fluctuate over time due to market conditions. Sometimes it will be high and sometimes it will be low. When the price is high, your fixed investment buys fewer shares. But when the price is low, that same fixed investment snags you more shares. This mechanism of buying more shares when prices are low and fewer shares when prices are high is the cornerstone of dollar cost averaging. It's like a built-in discount shopping strategy for the investment world. Here's the beautiful part. Over time, these regular investments can smooth out the impact of market volatility on the price of the investment. You're not trying to time the market or predict the highs and lows. Instead, you're maintaining a disciplined and consistent investment schedule, regardless of what the market is doing. By doing this, you spread the total amount invested over a longer period, which can result in a lower average cost per share. Why? Because your fixed investment buys more shares when the price is low and fewer shares when the price is high. This approach can alleviate the stress of trying to time the market and make investment decisions based on short-term price fluctuations. Instead, you're focusing on long-term growth and building wealth steadily over time. Ultimately, this strategy results in a lower average cost per share over time, hence the term average in dollar cost averaging. You might be wondering, what are the benefits of using the dollar cost averaging method? Well, let's dive into it. The first significant benefit is reducing the risk of making a substantial investment at the wrong time. Imagine you've saved a lump sum of money. You're ready to invest, but the market is at its peak. If you invest all at once and the market drops, you could lose a significant amount of your investment. Dollar cost averaging helps mitigate this risk by spreading out your investments over time, allowing you to buy more shares when prices are low and fewer when prices are high. Next up is the discipline it provides. Dollar cost averaging is a systematic approach to investing. It instills a disciplined habit of saving and investing regularly, irrespective of market conditions. This method encourages you to make investing a regular part of your financial routine, like paying bills or setting aside money for groceries. Over time, these regular investments can add up to a substantial portfolio, even if you're only investing a small amount each period. Lastly, dollar cost averaging helps smooth out the impact of market volatility. The financial market can be a roller coaster ride with prices fluctuating from day to day. This volatility can make investing feel like a gamble. But dollar cost averaging reduces this feeling of risk. By investing a fixed amount regularly, you're not trying to time the market or predict its highs and lows. Instead, you're creating an average cost per share over time, which can help to smooth out the peaks and valleys of market price fluctuations. So, to sum it up, dollar cost averaging helps mitigate the risk of poor timing, instills a disciplined saving and investing habit, and smooths out the impact of market volatility. It's a strategy that can help you navigate the unpredictable waters of the investment world with a bit more peace of mind. With dollar cost averaging, you can build your investment portfolio gradually and mitigate the risks associated with market timing. Despite its advantages, dollar cost averaging is not without its limitations. Just like any investment strategy, it's not a one-size-fits-all miracle solution. Let's delve into some of these limitations. Firstly, dollar cost averaging requires a disciplined approach. It's not a strategy you can implement haphazardly. It requires regular investment over a prolonged period, regardless of market conditions. This discipline can be challenging to maintain, especially during market downturns when investing might feel like throwing good money after bad. But remember, the essence of dollar cost averaging is to buy more shares when prices are low and fewer when they are high. The second limitation is the potential for lower returns in consistently rising markets. If the market is on a prolonged uptrend, a lump sum investment could yield higher returns. Dollar cost averaging, by its very nature, dilutes the impact of these growth periods. It's a trade-off. You're accepting potentially lower returns in exchange for reducing the risk of significant losses. Thirdly, dollar cost averaging requires a regular source of income for continuous investment. This strategy is less suitable for those who don't have a steady income stream, like retirees or those with irregular income patterns. It's also less effective if you have a large sum to invest up front, as it could be better to invest the lump sum and enjoy the full potential of compound interest over time. Finally, it's important to remember that dollar cost averaging doesn't guarantee profits or protect against losses. The strategy relies on the premise that over time, markets will rise. If the markets were to enter a prolonged downturn, the strategy could lead to losses. While dollar cost averaging has its limitations, it remains a valuable tool for long-term wealth building for many investors. It's about finding a balance between risk and reward and understanding your financial situation and investment goals. Like any strategy, it may not be suitable for everyone, but for those who can adhere to its principles, it can be an effective way to grow their wealth over time. We've covered a lot today, so let's quickly summarize. Dollar cost averaging is a strategy where you invest a fixed amount of money at regular intervals, regardless of the asset's price. It's a simple yet powerful approach to investing, reducing the impact of market volatility on your investment. Here's how it works. Let's say you decide to invest $100 every month. Sometimes, when the price is low, your money will buy more shares. Other times, when the price is high, you will buy fewer shares. Over time, this strategy can lower the average cost per share of your investment. This approach brings several benefits. It instills discipline in your investing habits, mitigating the risks of impulsive decisions driven by market fluctuations. It also allows you to take advantage of the market's ups and downs, potentially leading to substantial returns over the long term. However, like any strategy, dollar cost averaging is not without limitations. It's not a guarantee against loss, especially in persistently declining markets. And it requires a consistent investment commitment, regardless of the market conditions. Yet, for many, the potential of this strategy for long-term wealth building is undeniable. It's a tool that can help you navigate the financial markets and work towards your financial goals. Thank you for watching. Remember, understanding your investment strategies is key to building your wealth. If you found this video helpful, do subscribe to House Lux Estate for more insights into financial literacy and wealth building. Until next time, keep investing wisely.